Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I am joined by Gary Merkel of Elston. He's going to be sharing his insights on navigating the small cap investing landscape and how they're positioning in the midst of macro uncertainty. Welcome, Gary.
Great to be here talking small caps.
Lovely of you to join us. Geopolitics, trade tensions and shifting monetary policy have been dominating markets recently. How are you interpreting this landscape for small cap investing and where do you see the opportunities emerging?
Geopolitics and trade tensions have definitely been what's driving markets over the last 6 months. If we think about changing monetary policy, that's been more of a longer term issue and it's pretty heavily weighed on the small cap part of the market. If we look back over the last 3 years, the small cap segment has pretty dramatically underperformed the mid and large cap parts of the market. And we've gone back and had a look at past cycles where you've had these prolonged periods of underperformance. And interestingly, there tends to be a pretty strong period of relative outperformance that follows these periods. And we're starting to see that relative performance differential unwind a little bit, but we think it's still relatively early. And then if we combine that with thinking about the businesses in small cap segment from a bottom up perspective, we think the valuations look reasonable. So combining the two, we think there's a lot of opportunity within the small cap market at the moment.
You've spoken about staying true to label as small cap specialists. So even when your peers drift into the mid and large cap space, why is that important for you to stick to that discipline and how has it shaped returns over the past 5 years?
Staying true to label is something that is really important to us. So how we market our portfolio is high quality, high conviction, small cap portfolio. We want our investors to get what they expect they're going to get. If we're drifting into, say, mid and large, there could be unintended overlaps with other parts of our investors' portfolio. So we don't want that. We want to be true to label. Now, it would have been a far easier ride if we had have parked money in the mids or large over the last 3 to 5 years. But we're really proud of the results we've delivered, and that has come from generating alpha, within the small cap market segment. So true to label is in our DNA, and it's something that we've embedded within our mandate.
Mm-hmm. So the RBA has cut rates twice this year. Markets are expecting another one in November. How do you see lower interest rates flowing into the small cap universe, and which parts of the market are best positioned to benefit?
Yeah, it's really interesting. So 6 months into the monetary loosening cycle, first cut coming through in February, and we're already starting to see the benefits come through. So most recent results season, the retailers that we follow that are domestic focused, they all talked about having a strong Q4 and their trading update into the start of this new financial year indicated continued momentum within their businesses. So, those businesses that are consumer facing are already starting to see the benefits. But I guess if you really want to find the parts of the market that could be, supercharged with declining interest rates, it's going to be on the consumption side, and it's going to be more the millennial type cohorts that have really more acutely felt the cost of living crisis.
You know in the quarterly report that short-term moves are often unrelated to company fundamentals. How do you stay disciplined as long-term investors in the face of that kind of uncertainty?
It can definitely be hard, when there's high degrees of volatility. I'd be lying if I said it wasn't stressful, but everything we do, we've built up with evidence. So our process is structured and it's all evidence-based. So when things get quite volatile, I just trust in the process. So it's all evidence-based over the years. And we think, that makes it easier to sort of endure. But the other part of it would be taking the glass half full perspective. So when there's high degrees of volatility, that's when you're most likely to find the really good opportunities. That's where you get big dislocations in intrinsic values. So although it's stressful, it's times like that where you need to have your eyes wide open and be ready to pounce because you might find that entry value into something that could really make the fund over the next 5 years.
So small caps are often seen as riskier, which you just kind of alluded to. How does the way you construct the portfolio help manage downside risk while still capturing growth?
There's two elements to that. The first starts with the stock selection. So we don't like debt, or put another way, we like to invest in businesses that have no debt or cash on the balance sheet, or at the most little debt. And that really builds up from work we did when we were establishing the strategy. We went back and had a look at the last 2 decades of businesses that had failed, that had been within the small cap part of the market. And it was interesting because there was all sorts of reasons why businesses come unstuck. Like, things just pop up that can destroy a business, but a commonality across most was having too much debt. So we think that we can take that really bad scenario off the table, but by investing in only businesses that have really strong balance sheets. So that's the first part. The second part is within the portfolio construction stage. So we take a systematic approach to portfolio construction, where we are reweighting the portfolio to businesses that we assess as being higher quality. So they're more durable business. And if you combine the two, only investing in businesses that have strong balance sheets, and then a reweighting within the portfolio to the more durable businesses, that's the way we sort of look to try to mitigate downside risk.
Gary, can you share 1 to 2 examples of contrasting stock stories in your portfolio and explain what that tells us about the current state of small cap investing?
Yeah, well, we're still seeing a lot of short-termism within the small cap part of the market, and that was very apparent in the most recent results season, where we saw very divergent results across different companies. And Baby Bunting was an example of a business that had a lot of share price appreciation during the results season. And for those that aren't familiar with Baby Bunting, they've gone through a pretty tough period over the last 3 years. So their key customer, being the millennials, have pretty acutely felt the pain of the cost of living crisis, which has flowed through to same store sort of sales numbers for Baby Bunting. The newly appointed CEO, Mark Tepperson, has done a terrific job, turning the business around and really building it towards the trajectory where we can see it over the next 5 to 10 years. And his key initiatives being improving the gross margin between simplifying the promotional activity structure that they have. Secondly, he's refurbishing the store network, which admittedly is a little bit tired and outdated. They've been using a similar sort of format over the last 10 to 20 years. And thirdly, he's trialling a new small format pilot store. The first one being Robina on the Gold Coast. I was there for the opening day a couple of weeks ago, which was really interesting, very busy, very vibrant, and it was great to see. Now, the market got really excited about the initial results from the newly refurbed stores. So they're showing a lot more growth than what management was expecting. And it's pretty interesting. You just get that one data point and the share price has nearly doubled off the back of that over recent months. Now, on the flip side of that, we've had Ordinate, which is in our portfolio. The result was largely in line with our expectations. The guidance was a bit soft, so sales and gross profit a little bit softer than what we were expecting. But the big surprise is that they're looking to reinvest pretty aggressively back into developing new software products to overlay their connected ecosystem of Pro AV devices. And I think that really caught the market off guard and goes back to what I was saying about being short term. The market has sold that business off quite dramatically. When we think about that business longer term, the competitive advantages are still in place. So we aren't seeing them being disrupted by any of their peers. And we think that these new software products could add a lot of value to them and really entrench the business more. So we're still very positive, but it's just interesting seeing the contrasting movements based on just a couple of short-term sort of guidance numbers.
Can you also talk about any positions you have added to the portfolio, and on the flip side, have you trimmed any or exited?
Maybe start with the exit. So this goes on from what I was talking about earlier about being true to label. Hub24, that's a business that we've held in the portfolio for quite a long time. As it's moved up through the market cap spectrum and last year moved into the ASX 100, part of our mandate is to exit businesses as they go into the top 100. So remaining true to label small cap manager. So Hub has gone through the journey. It's now moving into the mid cap space where someone else can have a look at that. But it's been a great investment for the fund. A business that we've had, XRF Scientific. This is a business that could be flying under the radar for many. We've been following it since it was a really small micro cap business. And Perth-based, they sell consumables and capital equipment that they're dominating little niche markets within the sample preparation processing segment for commodities and industrial products. We see it as a quality compounder, so it's already quite established from a profitability perspective, but they just have a knack of being able to find new market segments and bring products that are a good fit. So slowly compounding out those sales and earnings numbers. So we think it's really attractive for a long-term holder of a quality business.
So finally, your 5-year outlook forecasts strong EPS growth despite macro uncertainty. While I don't expect you to predict the future, what do you see as the biggest risk and equally the biggest opportunity for small cap investors as we head into the next phase of the cycle?
Maybe starting with the glass half full part of that question. And as a small cap investor, there's always opportunity. We have so many businesses to choose from, so we can be very selective. So there's many stones to turn over to find hidden gems, as we like to say. So the opportunity is there regardless of the market cycle. From a risk perspective, the big macro risks that we've been worried about, so unemployment, inflation, interest rates, the health of the domestic consumer, are starting to moderate. And as I said earlier, we're seeing some green shoots, particularly from the consumer. So we're starting to get a little bit more comfortable with those risks domestically. I think the big one that we're really worried about is there's a lot of change that's happening from a technology standpoint at the moment. So we're really running our ruler over the businesses that we have, and this acceleration in technology change, trying to make sure that we're not going to be blindsided by any big leaps that are potentially going to come through over the coming years.
Okay, great. Thanks, Gary, for joining Livewire today and sharing your insights.
Thank you very much.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.